Hello and welcome to Switzer Investing Insights, brought to you by NAB Trade. And today we want to talk about how you can construct a balanced portfolio using exchange traded funds or ETFs. Paul, talk to us about what a balanced portfolio looks like.
Look, a balanced portfolio typically, Peter, has a mix of income and growth assets. We think of things like cash and term deposits and bonds as income assets. In other words, the main source is going to be the interest return from the asset. That's how you get your return. We think of growth assets as things like shares, international shares, property and commodities. The main return comes from the appreciation of the asset. You can still get dividends, but mainly the return comes out of the appreciation of the price of the asset. That's a growth asset. So a balanced portfolio typically is a mix between the two, typically 50-50, sometimes 40-60. So that's what we mean by a balanced portfolio.
Okay, so why don't you talk us through all the different sorts of portfolios people could consider?
Yeah, so look, here are some typical descriptors of portfolios, things called secure, defensive, conservative, balanced growth and high growth. You see those particularly when you're looking at your super allocation, having which super fund you go into. Do you go to the growth option or the balance option? And typically what separates them is the mix between income and growth assets. On the table in front of you, you can see those 6 portfolios. The income assets going from left to right from 100% down to 0%, and growth assets go from 0% to 98%. So as you get riskier and riskier, more growth assets, almost no income assets, and the very defensive portfolios have a much higher exposure in terms of income-based assets, and some typical allocations across those 5 sort of generic asset classes.
Okay, let's look at the ETF stuff out there that you can use to create a balanced portfolio.
Yeah, there are actually 3 ways to actually use ETFs, Peter, exchange traded funds, to create a balanced portfolio. Let's go to the first one, which is probably the easiest, Peter. There actually are 2 providers who actually offer fully constructed
That's
portfolios.
innovative, isn't it?
So BetaShares has what it calls a diversified balanced ETF, trades under the ASX ticker code of DBBF. So if you want to buy a balanced portfolio, you just buy units in DBBF. Right, 50% is a mix of income and growth assets, 50% income, 50% growth. And that fund invests in other BetaShares exchange traded funds, and also some other leading managers exchange traded funds to get the exposure across the different asset classes. They also have a growth ETF, ASX code DGGF, and a diversified high growth and a conservative income ETF, so some others to choose from. Fee is 26 basis points or 0.2.6%, plus the individual fees of the ETF.
Yeah, so in a sense there's a fee on each one and a fee overarching as well.
Yeah, good thing is you actually just get one security, Peter, and that's the balanced, and that's already your balanced exposure.
Yeah, right.
Vanguard does exactly the same. It has what's called the Diversified Balanced Index ETF, ASX code of VDBA, and that trades 50% income, 50% growth. That fund invests in other Vanguard wholesale index funds. Fee here is about the same, plus individual fund fees. The only difference between the Vanguard product and the BetaShares product is BetaShares invests both in BetaShares and other leading manager ETFs. Vanguard just invests in Vanguard.
Vanguard likes
funds.
Vanguard.
Yeah. So a really easy way, BetaShares, Vanguard, both offer 4 options.
Okay. So that's one way. What if you want to do it bespoke yourself?
Well, one of the other providers, that's iShares, who are part of the BlackRock stable, they actually provide a tool to construct the portfolio yourself. So you just go to the iShares website. They offer sort of 4 basic models or 5 basic models: conservative, moderate, balanced, growth, and aggressive models. You select what model you want, you key in how much you want to invest, say $100,000, and they come up with a portfolio of underlying iShares ETFs. And then you go and buy those ETFs, and that gives you automatically the balanced portfolio. There's no fee to pay because you're ending up with about a 6 to 8 underlying ETF holdings. There's no fee on the top of it, but you have different securities, and a real easy way to get set. So you've got Vanguard and BetaShares with pre-constructed models, iShares, which is giving the opportunity to really develop the model using their technology and their underlying funds.
Okay. So, but I guess at the end of the day, if you just want to go pick and choose like a smorgasbord of ETFs, you can do that as well.
Yeah, you could use, for example, our target asset allocations or look at some other models and work out where exactly you fit. And you can then actually select the ETF. So you work out what type of investor you are, what type you want across the different asset class, and go and buy the best of breed ETFs. So, for example, if you're looking at best of breed ETFs, you might look at for cash, or you might look at Bill from iShares or AAA from BetaShares, bonds for the domestic component, VAF from Vanguard or IAF, which are their broad fixed interest funds from iShares. International bonds, some of the credit funds. Vanguard has a credit fund. There's also iShares with IHCB. Property, you can get a specific property ETF security. Australian shares, the Vanguard VAS tracks the ASX 300. IOZ from iShares tracks the ASX 200. International shares, VGS, which is exposed to all international shares from Vanguard, that's their main product. There's also VGAD, which is the hedged version, or you can look at iShares, iWorld, IWLD, or IHWLD, the hedged version. So pretty easy to sort of go to the major ETF providers, select the ones that you want, and create your own.
Yeah, and as long as you have in your head what percentage you want to be defensive or income, and the other percentage is going to be growth, you can make it yourself. Yeah,
there are some disadvantages with this model. Of course, if the ETF provider is doing it, they're rebalancing, and of course, things get out of balance, as markets move up and down. But the downside, of course, is you're paying a fee for that to happen. Here, at least, you're doing it yourself, and you get the underlying securities.
Well, Paul, do you use ETFs?
Look, I absolutely use ETFs, Peter, particularly for my overseas investments. Australian market, I probably prefer to do it myself, but they can be useful. And I think for an investor, we always think that asset allocation is probably the most important thing. That's what all the books, all the theory about, all the research tells us when it comes to actually investing. So being able to get the right asset allocation that suits your risk and your profile and your needs and your objectives is really important. Getting ETFs and using an ETF to potentially do it can be a really important step. As long as you're happy to accept what we call average performance, because that's all you get from an ETF. You'll get the index, less a fee, you won't get outperformance. But look, for many people, that's not a big trade-off.
Yeah, I use ETFs when I say buy the dip, I can't find a stock that I actually like. I've done that. And when I go overseas, I've used IVV and IHV for hedging purposes when the dollar got really low. But I think ETFs are a really useful product for many situations. That's Switzer Investing Insights, brought to you by NAB Trade. Thanks for joining us.